we always think clearly as investors ourselves, what's most likely to work going forward. And if you take a very basic model from 20 years ago, is it likely to work as well going forward as models that have been refined and have had new features added, and where you've changed your execution profile, all these different improvements? And the answer is that it's easy to replicate the past. It's quite difficult to replicate relatively sophisticated strategies going forward.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kaastrup-Larsen.
Hey everyone, and welcome back to another edition of Top Traders Unplugged, where today Alan Dunn and I are joined by Russell Korgaonkar, who is the Chief Investment Officer at Man AHL, as part of our mini-series focusing on the one investment strategy that beat everything else in 2022, namely trend following and managed futures more broadly. First off, Russell, thanks ever so much for joining us today. We really have been looking forward to this conversation. I hope you're doing well. How was New Year's for you? Quiet, I hope.
New Year's was sufficiently quiet. Yeah, I was with the family, but it was the end to quite a hectic year. So I'm glad we had a quiet New Year's.
Yeah, no, I can imagine, and of course we're going to be diving into a lot of that. But because we do have quite a few different topics that we're going to discuss, I would like to set the stage a little bit for our conversation so that the audience knows a little bit about Man and the background. So, without taking too long, do you mind sharing a few highlights about kind of the types of strategies that you focus on, and also kind of where the industry or the business, I would say, sits before we head into 2023?
Yeah, sure. So Man Group is a large alternative manager. We run many different types of funds, many different types of strategies. Broadly speaking, split between systematic and discretionary, and we don't have too many things that do both. So AHL is in the systematic part of the business, and even within that, we run many different types of funds. Our heritage was as a trend follower, but we run quant equity, we run long only risk managed strategies. The key thing about everything that we do is it's systematic 100%, and we're active. So we trade a lot. And those are the common things are we trade and we do it systematically.
Yeah, no, that's great. I appreciate that. Now, for our conversation today, both Alan and I have created kind of a list of different topics, and we won't have time probably to get through all of them. But we'll pick a few of them as we go along. So maybe, Alan, I could ask you to kick things off with kind of the first topic of today.
Great, yeah. Well, good to speak to you, Russell. You've touched on everything is systematic and you're active, which gives us a sense on your philosophy around markets and trading. But if you were to describe that philosophy, what would you say that is in terms of what's the belief that underpins everything about the trading strategies?
Yeah, I started in this business 20 years ago, and I couldn't actually believe that there was an edge in trading at all. I always thought it was likely to disappear fairly quickly, and so that was 20 years ago, and it's still here. So there must be something that's working, and I guess our belief within AHL is that across markets there are small opportunities and small inefficiencies, and in order to capture them, you need to be able to move positions around to trade in an efficient way, because obviously trading is always going to be a drag on performance if you're not doing it sensibly. And then you need to be somewhat sensible and pragmatic about where those opportunities exist and also when they stop existing. And a big part of being successful in the systematic space is not actually just knowing what to trade. It's also knowing what not to trade. So we spend a lot of our research process thinking about that, thinking about the drivers of returns, thinking about where inefficiencies might exist. And then when we find them, we want to exploit them as efficiently as possible and in as diversified a way as possible. So in many different regions, many different markets as we can. And we find that putting all of those things together, so efficient trading systems, very well diversified, you can then take those small edges that you find and turn it into something that makes an interesting return stream.
And you mentioned, trend following is the heritage of Man AHL, and how you were surprised 20 years ago that those types of strategies work, and they seem to be still working pretty well, judging by the industry's performance last year. What's your perspective on trend following? Why do markets trend? Why does trend following work?
Yeah, trend following, I think, is one of those. In some senses, one of the most straightforward of strategies, but also in other ways, one of the most elegant. And the reason I think it works in the first place, the reason why you tend to get autocorrelation in price moves is pretty much down to three reasons. The first is that information doesn't flow immediately. It takes a bit of time for information to diffuse into a marketplace. And in a sense, markets therefore aren't 100% efficient. They take time to absorb. And that means that a piece of information that you might expect should move a price 5% doesn't instantly move it 5%. It moves it maybe 3%, and it takes time to propagate. So that's number one. Number two is that markets themselves and drivers of market returns tend to be autocorrelated. So if you think about the Fed and levels of interest rates, or inflation readings, or economic data, all of that tends to move fairly slowly. It doesn't jump hugely from one place to another. It does sometimes, but most of the time, that tends to move in the same direction. So the world, to a degree, and the drivers of markets are autocorrelated. And then the third, and probably for me, the most compelling and the most the one that kind of stands the test of time is behavior. And if any of us are trying to sell a property and property prices are going up, we're keen to wait for a better price, and if they're going down, we'll take the first bid, and that's just human nature. And human nature actually that goes back as far as we have data for prices. It goes back to ancient Sumeria and some of the ancient scrolls that have been discovered about wheat prices 5,000 years ago, and they tended to autocorrelate. So I think that's the main reason.
And obviously, you guys run more than just trend following strategies, so it's trend and non-trend strategies. Would you say it's those same factors that is the source of inefficiency in markets, or the source of opportunity for the non-trend strategies as well?
Not necessarily. I think each strategy has its own inefficiency that it's trying to exploit. Sometimes that's trading inefficiency or liquidity inefficiency, which is less behavioral and more liquidity driven. If there's more demand for a certain asset that the price moves don't justify, then that price move tends to revert. It's quite a different inefficiency. And likewise for many of the fundamental strategies that we would run, where it's more of an information inefficiency, if you like, that there's some piece of information that's not fully reflected in the price. So I think it depends, but trend following, to my mind, is very much a behavioral phenomenon.
Fair enough. So maybe just the last one on this topic. I mean, if I was to describe the Man AHL approach, it seems to be trend at its core, but trend plus other strategies. How would you see yourself relative to other peers in the industry? Obviously, the classic answer to this is, well, you don't know what everybody else is doing. But I mean, versus a pure trend follower or other types of strategies or managers, do you see yourselves as doing something particularly unique that you would kind of highlight when you're kind of presenting yourself to investors?
Yeah, I think it's difficult in our industry to claim anything's truly unique. There are a few things that I've come across in my time that I would hope are unique, and there's certainly plenty of IP that gets created in the teams at AHL that is novel IP. But the thinking about trend, for example, all trading systems, when it comes down to it, what you're trying to deliver is the best return that you can for a given risk target or risk profile. And trend followers have a particular risk profile and risk target. And what all of our work leads us to try to do is to maximize our expected return for that risk profile. And that comes in many different forms. It's the set of markets that you trade, the set of signals that you trade, how you group those signals together, how you execute, various risk limits, etc. So there are many things and parts of a system. And our belief has always been that you can take basic trend following, which is a fairly low sharpe strategy, but with nice risk properties, and then you can improve the expected returns of that strategy without changing the risk properties, without making it not a trend strategy or not having defensive properties and everything else. But you can make it more digestible for investors, because as much as last year was a very good year for trend following and very welcome in the context of a bad year for markets, most investors, they don't really have the stomach for years and years of really poor performance. And that means that they need to be in place. They need to be there with capital invested for when markets are more conducive to trends.
I wanted just to interject here with a small sort of question. I know Alan has a few other things to follow up on, but you kind of mentioned that yourself in terms of it was a gratifying year and a year where other things didn't do so well. And it kind of takes me back to, 2009, 2010, to talk about crisis alpha, when Katie Kaminsky coined that term. And back then I was quite excited about it. Because I thought, wow, here's a term that probably most members of investment committees would understand if you came in and said, we're going to allocate some money to a crisis alpha strategy. But then I'm also thinking, well, I don't really know any trend follower who specifically put anything into their models to make money in a crisis per se. So I'm just curious, what your thoughts are on this, and if you do or don't do anything specifically to try and have a certain performance payout, so to speak, in periods of equity stress.
Yeah, it's interesting that you say that. I would agree. I think trend followers going into 2008 didn't consider in particular performance during negative equity markets. I think they thought, here's a system that tends to work. It tends to have nice return properties, and that was the focus. And then 2008 happened, and and probably in the aftermath of that, with performance not being so brilliant, actually, directly after 2008, that then the focus is on, if you don't get quite so much return, at least you get the good performance in tail markets. I think if you talk to most institutional investors, they care about both. I mean, clearly they care about the return side, but they also do care about the crisis alpha or genuinely diversifying, because there are things or strategies that are diversifying in the sense that the average correlation is low. But that's actually different from strategies that tend to do well when the market does really badly. And trend following by its nature is one of those things, because when the market does badly, it doesn't. I mean, COVID was actually an exception, that there was a very, very short-lived market sell-off. But most of the time when you get market panics, it happens over the course of weeks and months. And that creates nice environment for trend followers, so they tend to do well. So I think it's it's one of those things that was never the original intention, but as time has gone on, and perhaps as people's what they value has evolved and changed, it's become part of the lexicon.
Yeah, I mean, it's interesting. This kind of gets to this kind of topic that came up on a recent paper from Cliff Asness, and where he said there's a dual mandate, effectively, absolute return plus crisis alpha, and it sounds like that that you're suggesting maybe that's not strictly part of the mandate, but more of a feature of the historic performance of trend following. You also touched on how the evolution of your systems has been towards making trend following more digestible for investors to ensure people can stick with it and then participate in those periods. But I guess is there a bit of a trade-off in terms of getting that bit more digestibility of the strategy? Are you giving up a little bit then of some of that, either the crisis alpha or some of the convexity, or some of those? You mentioned that maintaining the risk properties, broadly speaking, but is there a trade-off in those two objectives?
I don't think so, actually. I think that the key point about the crisis alpha is that if you run a very, very slow trend following system, so if I did something that said, if the price is higher than it was 12 months ago, I'll buy, and if it was lower than it was 12 months ago, I'll sell, and you look at the properties of a system like that, then it actually doesn't have particularly brilliant tail properties in a crisis, because it can take quite some time to switch around. It might have okay properties in terms of return, and it will certainly have good properties in terms of diversification. But in terms of crisis protection, it tends not to be quite so perform quite so well in equity stress environments. And so in order to have a system that does better, you need it to be a bit more reactive. Now that's the key point about crisis alpha. And if you look at different types of funds over different periods in the past, actually that can often separate styles. So most of the time, same for trend followers, most of the time they'll look fairly correlated. In periods in which the market moves fairly quickly, actually they can be positioned different ways around. So things like COVID is a good example, or Q4 of 2018, when we went from a low rate to attempted higher rate environment, and then they gave up on that. But those periods where you've got markets kind of really changing, in the last year we've had markets changing in the sense that you had volatility coming into rates and rates going up, and that causing all kinds of knock-on effects, obviously because of inflation. But that then led to very long, protracted trends. So actually, if you're a slow trend follower last year, it's the best thing you could have done. But the crisis alpha bit can be different, because there's different types of crisis. That's the most important thing. And typically speaking, the more reactive you are, the more likely you are to deliver a positive return in a crisis.
Fair enough. No, that's absolutely true. I guess the other typical kind of classic strategy that people might add to trend in a kind of a multi-strat kind of managed portfolio that Cliff Asness alluded to would be something like carry, which would tend to be uncorrelated, and carry is the classic kind of opposite return profile of kind of trend, where you consistent returns and then the periodic blow-ups. By combining carry type strategies, would that be blunting that kind of crisis alpha for wanted, and that kind of return, that convexity, I guess you might call it?
Yeah, I think it depends how you construct it. So if you just had a carry return stream, and you had a a trend return stream, and you said, right, I'm going to blend them 50-50, then clearly the properties of that combination are going to be, well, you may expect a slightly higher return possibly for average risk, but you may expect not quite so good return during equity stress because it takes you longer to build into those defensive positions, or maybe you pick up some of that negative skew that you get from FX carry, for example. So one way you can try to get the best of both worlds is saying most of the time when markets aren't trending, they aren't in a particularly stressed state, then perhaps carry makes a bit more sense. That's the kind of time that you'd like to be invested in carry. But if markets get into a stress state and they become, they enter either negative trends or they enter a higher volatility environment, then trend becomes the dominant feature. So that's not exactly the same as adding the two things. It's like saying, well, carry's okay, except when trends are very negative, in which case I should have zero carry and focus on the negative trend.
Yeah. Maybe one final one on this topic is, do you philosophically kind of leave it to investors to choose? I think, a lot of the larger firms now have kind of a solutions business to say, from an investor, do you want a pure trend? Do you want trend plus? Do you want trend plus other strategies? Is that the way it's gone? Or, or do you guide investors as to what's the appropriate program or strategy for their circumstances?
Yeah, it's definitely gone that way a lot more in the last few years. I think as for a couple of reasons. Number one, I think the offerings have become more diverse. You've got core trend, and then you've got alternative trend, and then you've perhaps got some trend plus or quant multi-strat, etc. And you've got all these various blends. And we've certainly noticed that over the last few years, more investors would like to have a bit more discretion in terms of which elements they allocate to and what features are most important to them. So it's certainly gone in that direction. That's not the case for all investors. You'll get some who will say, what's the highest sharpe ratio you can give me, and that's fine. But it's definitely got to, for the larger institutions, it's become more customized than it used to.
Before we jump to the next topic, which I'm quite interested in, I do want to just follow up on something you just mentioned there. You mentioned the sharpe ratio, and I'm curious on your thoughts as to whether you think our industry has become too concerned about sharpe. Is that actually a limiting factor for us in order to deliver what we think is the best way we can deliver things like trend following?
Yeah, I that's a good question. I think sharpe can be a fairly crude measure at times, especially for something like trend, where what do you care about, the volatility, or do you care about some other downside feature? So whether it's return over downside deviation, or it's return over some average measure of drawdown, or it's some other measure that's correlated to the tails, I do think that matters. And we do, when we're having those conversations with institutions, we do try to run through those that way of thinking. Don't just think about the sharpe ratio. It's okay. It's a useful measure, all else equal. But it's useful to think about those other return properties as well. And I agree with you. If you think just too much about sharpe ratio, if in a naive world, if you were given something that had a sharpe ratio of 2 and something else that had a sharpe ratio of 0.8, let's say, you'd say, well, I'd always take the 2, wouldn't I? Well, not necessarily, actually, especially not when the 2 can come with a nasty tail that you've not yet seen.
No, absolutely. No, I appreciate that. Now, the next thing I wanted to talk to you a little bit about is something that has become quite a big business in 2022, but it's not new as such. It's been around for a while. Lots of people, or some people have tried, some people have failed. There seems to maybe be one group out there right now that seems to be doing a good job, but we don't have that much track yet. And what I'm talking about is trend replication, or maybe CTA replication. where essentially the argument is we can do it for a lot lower cost, and therefore you're going to be outperforming just because of the savings of those costs. How do you feel about replication in general? And maybe I'll give you the second follow-up question even now, and that is if you have any concerns or if you see any weaknesses with replication in our space.
Yeah, look, you guys may have remembered the time during the 2000s when there was this big kind of phenomenon called hedge fund replication. And what people did is that they took returns of hedge fund and they regressed them against some kind of simple metrics. And they said, I can replicate the hedge funds with these kind of simple betas, and I'll give you the same thing for a lot lower fees. It's really easy to replicate the past. It's really very easy to make things that look good in back tests, that explain variance in back tests. But going forward, you need we always think clearly as investors ourselves, what's most likely to work going forward. And if you take a very basic model from 20 years ago, is it likely to work as well going forward as models that have been refined and have had new features added, and where you've changed your execution profile, all these different improvements? And the answer that we've kind of done studies on this for many years, and hopefully I would like to think proved it through trading as well, is that it's easy to replicate the past. It's quite difficult to replicate relatively sophisticated strategies going forward.
But let me follow up on that, Russell, because I think what the people doing it would say, yeah, maybe we can't replicate one particular firm. But when we take the SocGen CTA index, for example, or now I think actually some people are coming out with some kind of AI version of the SocGen trend index, then it's a different story. We can take the return streams and we can figure out what their likely exposure is, or a way to replicate their exposure through a smaller number of markets and so on and so forth. Of course, as I said, the data is still relatively short, but so far it looks like they have done it. I have my personal concerns, but this is not about my concerns today. It's about your concerns, if any. So I'm just curious whether you think that maybe that part of the business has also evolved, and maybe maybe it's a different case when you do an index of trend followers or CTAs. I don't know.
I think it depends on what you're trying to do and how you're trying to do it. But certainly, utilizing some return information, creating a model to try to explain those returns, you'll always do a good job of explaining the returns. And you'll always come up with a model that looks like it is explaining a lot of why those returns have been as they are. But I guess my point is, in order to make a better system, actually, you need to replicate the positions, and ideally the positions slightly ahead of time, and be able to trade those positions very efficiently. And that is something that I think it's easy to overlook the importance of that, the complexity and the importance of it. So I and we've all been around for years in which these things come into fashion and they go out of fashion. But the key, from my perspective, and the key message, I suppose, to investors is to think about your expected returns going forward. What makes you convinced that whatever strategy or firm or setup or platform, whatever it happens to be that you're utilizing to produce returns, why do you have conviction that that's going to work going forward? And so I think the whole setup of saying, well, I'm going to try and figure out what others are doing, try to replicate it, and then implement it in a kind of slightly simplistic fashion, I think that's it would be difficult for me to have conviction in that going forward.
Alan, now we're heading over to something you love to talk about.
Well, I mean, I guess we've kind of touched on this a little bit. It's the whole kind of research. You mentioned how models that were developed 20 years ago might not work so well now, and you kind of how all of the work you've done on various models has helped improve things. I mean, against that, there are some trend followers I'm aware of in the industry who've had fairly stable systems, kind of what they might call classic trend followers, who seem to have done very well. The question is, I mean, how important have those improvements been? Do if you kind of ran systems that had been run 20 years ago now on current markets, say like obviously last year is a very good market for trend following, how much behind would they be, kind of the performance of the more up-to-date models, or can you kind of quantify the benefit of the research?
Yeah, we have a process here that tries to focus on that specific question. There's always the challenge with systematic investing that you have a model that works okay, and then you have a group of researchers, and they do lots of research and they come up with some back tests and some theories, and always those back tests make the system look better in the past, right? They always make the system look better. But that's very different from saying, do they make the trading system better in terms of live performance? And so, part of our entire process at AHL is to focus on that question: what's the value of changes been? And if you apply that to any single change, it's very noisy, right? Let's say you make a change where you add a new predictor, or you change the speed of trading, or something like this. It's very noisy as to the impact that has over 1 year. But if you're doing hundreds of change, making hundreds of improvements, then you start to get a sense of which of them are useful, which are not so useful, and etc. And what we found over the years is tweaking a kind of trend following system, for example, doesn't make much difference. You can fiddle with the speeds here and there, and you can fiddle with the market weights, but it doesn't tend to make a huge difference. Adding markets that are genuinely diversifying, that makes a big difference. And adding models that are genuinely different somehow, that also makes a difference. So it's a big feature of what we've done. I would say last year, by the way, the more basic the trend following system, the better. The thing that held on to being short bonds for the whole year and was a bit kind of slower and a bit more basic and didn't have so much risk controls or risk management in there, would have done spectacularly well. But in the fullness of time, in the different types of periods, the research and improving things, that for us has definitely made a difference.
And I mean, you touched on kind of tinkering with speeds a bit. I mean, as far as I'm aware, like if you went back to the 80s and I think the 90s, fast trend following did better back then, and there's been kind of a degradation over time, and kind of a suggestion that the industry has shifted to be a bit slower over time. I mean, if you notice something like that, that there seems to be a degradation, I guess what would it take for you to kind of significantly change the profile of the overall system in terms of its speed? And would you need kind of some intuition around that something is changing in market, that the market microstructure might be changing to shift things, or would you just be driven by the data?
I think often what happens is, number one, you need good analytics for these types of things. So you need to understand how those patterns have evolved through time. And the second is, if you have an intuition as to why, then it really hugely helps in making decisions. And so in that example of fast trading stopping working, or fast trend following to a point, that's fairly intuitive. As markets get a bit more efficient, you would expect that if you go back to your question at the start about what drives trend following, and I said one of the things was information leakage. Well, I think that thing has got, there's a lot less information leakage through time. The markets have become more efficient. And therefore, you might think that particular inefficiency drives short-term trend following much more than it does long-term trend following. And so we might reasonably expect that as markets become more efficient, which is not all markets, by the way, it's some markets, that those types of signals tend to perform less well, and you would expect that it's not going to come back. It's something that was there when markets were less efficient. They become more efficient, and they're not going to become less efficient again. So I think the intuition helps. I mean, you need to be careful about being too confident in whatever assertions you make, because markets always tend to have a way of surprising people. But I think those are the two things that we'd use. Good data, good analytics, and then some intuition as to why something's happening.
Fair enough. I mean, for a lot of managed futures managers in the last number of years, it seems that execution has been a big area of focus, and that seems to be almost becoming a source of alpha. Has that been the same for you guys? And with some medium to long term systems, I've heard the suggestion from managers in the past that, well, it doesn't really matter if we traded today or tomorrow. I mean, from a medium term trend following perspective, it's a bit of a wash. Would you agree with that? And then why is execution and being so timely so important for these types of systems?
I think what execution allows you to do, what really good execution allows you to do, is harvest a richer set of alphas. And that's a really important thing. So if I was running like a really basic, slow trend following system, I don't think that my execution quality matters that much. You're someone who said you could do it today or tomorrow, and it doesn't make too much of a difference. I think that's probably a reasonable statement. But what a really good execution system allows you to do is introduce many different types of alphas that you can trade around the edges and still be retain the overall risk properties of your system, but improve the expected return. So an example of that, we've got a team here at AHL who are running short-term trading models. And short-term for us is kind of hours to days. It's not super high frequency, but it's not super slow. And they were making good P&L, very diversified from trend following, very different set of signals. Good P&L, but it's kind of capacity limited. There's a certain amount that you can put into those types of systems as a standalone, and they were operating as a standalone team. But if we use some of those alphas, some of those skills that they have, and use it to adapt the trade profile of slower systems, then actually what we can do is we don't change the amount that we trade at all. We just change slightly the timing of the way that we trade. And that means that we can exploit a lot more of that alpha in a bigger scale. So I think, to answer your question, that's what it gives you. Really good execution gives you more ability to enable different sources of alpha.
Yeah, no, I was, there's a couple of things. One, and you've already kind of alluded to it. So maybe for me, it's more of a little bit of a statement. You mentioned this thing that it's much better to trade more markets, especially when you can find diversified ones. And I think that makes logical sense. However, I've often said on the podcast that when I look at our industry, I don't really see any strong evidence that the firms that at least I know that trades hundreds of markets, that they are performing better. Maybe they can manage more money. That's fair. That's also valuable, of course. We'll leave that at that. However, one thing I've heard you say in the past, which I would love for you to repeat here if you remember it, and that is, you had this great explanation where you talked about why you think it's better to have dynamic position sizing or dynamic position management compared to static, because this has been a big conversation between some of my co-hosts here on the podcast. And I don't think there is a right or wrong per se, but I'm always curious to hear different views as to why people feel one way or the other. So I don't know if you remember, Russell, what you talked about, but it had something to do, I think, with the fact that volatility changes, risk changes, and so on and so forth. Yeah.
Yeah, I don't. So there's a danger here that I'm completely contradicting.
That's fine. No
I said in
worries.
the past, but I would, hopefully I give the same answer. But that bit in markets is hugely important in our understanding of them, and probably in our entire philosophy of how we approach trading systems. Returns in markets are fairly difficult to predict. There's a fairly small edge. But risk in markets is much easier to predict, and it's much more time varying, and it's intuitively time varying. And there are so many examples of that we'll have lived through, but perhaps some of the listeners haven't. If you remember credit markets back in 2007, you would have been trading for several years and not really seen anything in the way of volatility. Very calm market, maybe credit spreads moving a couple of basis points a day. So all of a sudden in July 2007, some stress started coming into that market, and 2 basis points turned into 3 and turned into 5 and turned into 10. And all of a sudden, day after day after day, the order of magnitude of the moves, or the moves are an order of magnitude bigger than they have been. And so what position scaling allows you to do is to control risk. And if you're not careful and you get the wrong side of an event like that, it can have a hugely damaging impact on returns. You might get the right side of it and you might be lucky, but we would approach all of these things as we want to maximize our chance of maximizing returns. In order to maximize our chance of maximizing returns, we need to make sure we're still around and still functioning and still preserving our capital base.
Okay, if I can just interject there, because the argument from the other side of the argument would be that, well, that's what our stop loss will do. That's going to keep us in business. It has kept us in business for decades. And by changing positions, there is a risk. And I don't want to, I have my own reasons as to why I don't think this applies, but they, that there is the argument that, well, the money you're going to make on the outliers that trend followers are sort of deep down hoping for and hunting for is going to be smaller. Now, again, I don't want to put forward my view on this, so I'd love to hear your view as to why you think that still, even if you may at times be reducing position sizes, you're still not going to lose out from, having a static position into a trend like whatever, Tesla, Moderna, whatever, just to pick a few really big ones that we all remember.
Yeah, look, I think if you're looking at a very diversified portfolio of positions, you could argue that, well, if I've got good stop losses in place, I can control my risk profile that way. And I'm sure there's, you could do some empirical tests and illustrate that to be the case. I would say though that given that we know that risk changes through time, intuitively we know it, we feel it, we see it. There's, as much empirical evidence as anything in financial markets that risk predictably changes through time. Then you, in my view, want to be able to trade your system, particularly in risky markets. In risk, stressful markets are the markets in which trend following systems tend to do best. And so what position sizing allows you to do is stay in the game during stressful markets. If you just had a stop loss system, it might be that the market swings around and it knocks you out, and then you lose your exposure for that period coming up. So I would say good risk management is, or dynamic position scaling, whichever way you call it, just allows you to, run your systems whatever the market conditions.
Yeah, I guess changing gears a little bit, talking about, I guess it's related to this in terms of managing drawdowns, and I suppose that's what you're getting at in terms of that position size management. But more generally, it's a philosophical question. You touched about at the outset why markets trend and why trend following works, but you obviously have these periods where trend following struggles, and we have these long drawdowns. And I suppose if you think about it, it's not like that speed of dissemination of price has changed in those periods, and it's not like people's behavioral biases have gone away in those periods. So why does it seemingly stop working for periods, or why is it performing less well in some periods?
Yeah, so I think people's first concern, and certainly was their concern for many years during the last decade, was, well, everyone knows about this strategy now, and it's become quite crowded, and therefore, why should we expect it to work anymore? And that's a perfectly logical and understandable hypothesis for any system. If huge amounts of people are doing it, surely it becomes less efficient. There's one quite nice way you can test this, which is to say, split your trend up. So take a market, and let's say I create a trend signal using moving average crossover. So I have some signal that tells me at some point, if the fast moving average goes above the slow moving average, I take a long position and look at the price evolution of that market. At some point, it will reach a peak. The trend followers never exit at the peak. They need to see the price coming down again before they exit. And at some point, the fast goes back below the slow, and you exit your position. So you've got an entry point, you've got a maximum, and you've got an exit point. In order for trend to be profitable, the exit needs to be higher in the case of going long than the entry. But that's quite a nice way of decomposing the return, because then you can say how much is due to my trend and how much was due to the reversal. And you may expect, as markets become, if you just do a thought experiment for a second, you say, I'm just going to dump loads of trend followers into a system, and I'm going to keep adding the impact of trend followers to a system. What tends to happen? Well, it doesn't make the trend any worse, actually. It tends to push the price up a bit more. And if anything, it can kind of overextend the trend. But what certainly happens is they're all exiting the position at the same time, and it makes the reversal much worse. So that's what happens in theory. What happened during the 2010s in liquid markets, so when I say liquid, I mean G10, the biggest markets out there, wasn't that the reversals got any worse. It was that the trends weren't as strong. And I would say that the reason for that, our hypothesis, is that you had very compressed markets during the 2010s because you essentially had interest rates floored. You had central banks acting as a kind of backstop behind markets. You had them acting in concert. And so during this period of very, very loose monetary policy and coordinated central bank action, all of that served to compress volatility and make markets more correlated. And if you think about what's good for trend, which is a positive convexity strategy on lots of markets, you want low correlation and you want things to move. And when you took markets that were kind of less influenced by central banks, well, those continued to trend pretty well during the last decade. So, given all the evidence, I would say that's our explanation.
Neil, so that's probably a good segue into, that discussion around capacity and AUM.
Yeah, no, absolutely. We'll try and hit a few more topics before we wrap up for today. And it is something that I think is talked about a fair bit. And, do people end up with too much money in the strategies? And so I'd love to hear your thoughts about capacity in general, but maybe also about fees. I've come across, obviously we know that there's been a lot of pressure on fees, but not just in hedge fund, but certainly in CTAs. And we've seen a lot of these flat fee products come out. And I apologize because I don't know exactly what fee structures you offer. So I don't know if I'm treading on any toes here. But what I've come across more recently, which is kind of interesting, and that is that with some of these pension fund money that came in quite, big time during the last 10 years, fees were beaten down a lot from the, in the firms where they took the money. And now I see kind of some evidence of the fact that some of that money is now being returned to these clients because the fees are simply not attractive enough because there's more demand and but also there is a capacity issue that firms know that you can't continue forever to just add more AUM. How do you think about this? Is it something that's an issue in for you or just in general? I'm curious.
Yeah. So my view on that is first off, most strategies have a capacity limit. It's different for different types of strategy. So if I were to take alternative trend, as we call it, trend on alternative markets, that's limited by how big a position you can take in various markets. And typically that how big a position you can take is a function of liquidity and how quickly you can exit that position. And all of that, when you put it to constructing a portfolio, sets a limit on how much AUM you can run. And the same is true of all strategies to some degree. Now, trend following on the 30 or 50 most liquid futures out there is a huge capacity strategy. You can run a lot in that type of strategy. And pricing really comes down to supply and demand. If there's huge amounts of supply and lots of people are providing you the same thing, here you go, here's exactly the same return stream, and that's what you're buying. Then clearly, if there's lots of supply out there, then the price should reflect it and it should come down. And where there's kind of limited supply, and you're offering something that's valuable either in the sense that it's limited or valuable in the sense that it has better properties, then the price of that's going to be higher. And I tend to think, in all honesty, the marketplace kind of sorts itself out. I mean, we're all going to believe in free markets, and that is not just true in terms of trading; it's true in terms of investors as well. And so, the products that we run that are closed, which is a lot of what we do, demand a premium as you would expect, and those where we can run really high levels of capacity and there's a more competitive marketplace for it, we can run it at lower fees. So we'll try and cover both.
Okay, no, that's fair. We only got another sort of 15 minutes or so, Alan. So let's see if we can hit the last few topics. With Russell. Well,
maybe just talking about the role of managed futures and trend following in the context of a larger portfolio. So if I was like running an endowment or something like that, coming to think about how much to allocate to trend following, what's the role, and maybe first of all, how should allocators be thinking about the expected returns for these strategies? Obviously, you can look back historically and say, since 2000, whatever it is, the SocGen trend has a sharpe of maybe 0.4. It might be a bit higher after last year, but whatever it is that the starting point, or is there any other way of thinking about expected returns for strategies like this?
I think in terms of the fit to the portfolio, people need to do modeling of whole portfolios, and they need to think about tail scenarios as well as average years. And the perhaps useful position which we're now in is that after having years of real plain sailing for most static long only portfolios, they've really appreciated the value of a more active approach and a more complementary approach last year. So that's something that certainly we would emphasize. Think about properties during environments which are difficult for the rest of your portfolio, not just average correlation, but in particular tail properties. And then in terms of expected return, I mean, we wrote something, I don't think we ever published it, but we did it for some of our clients several years ago, kind of categorizing, okay, if you take a straightforward trend system, it has an expected sharpe of about 0.4. If you do various, add alternative markets and you change your execution, you add some different then you can retain those same overall risk properties, but improve your expected return. And so I think where you want to get to with trend, and certainly where it's been over the years, and I think it should be going forward, is you should be able to add trend to your portfolio, and it doesn't detract from the expected return of your portfolio. It should at least keep it as good as it was before you added the trend, and very much improve the tail.
Okay. So, I mean, when, from my experience of speaking to other investors and, presenting managed future solutions, that, once people say, yeah, I like it, the next questions are typically, how much and where do I fund it from? Is it from the kind of the equity side or from the fixed income side? And then sometimes there's the additional question of, can I time this? How would you answer those questions?
I think in terms of where you take it from, trend should be a genuinely diversifying return stream to any static investment. And therefore, really, you should keep the bulk of your portfolio weights the same and just say, let's say I had $100 and it was 60 equities and 40 bonds. We'll just multiply both of those bits by 0.9 and give 10 to trend, and that should improve the properties of a portfolio. Sorry, your second question.
So then is how much? I guess, if you ran an optimization historically, bonds, equities, and managed futures, it would tend to come out with, a number that most probably institutional investors would find very high.
Yes.
So is that still the right answer, or, how to think about sizing?
I think it depends on the mandate of the investor, to be honest with you. If I was answering the question on a personal basis where I don't have any benchmarks to worry about or anything else, then my percentage would be pretty high, because I think I would hopefully think I could access some high expected return trend systems, and therefore if the expected return of something is higher than it is of stocks, then you're likely to have a higher allocation than you would to stocks. I think for most investors that's totally unrealistic, and they're very aware of their benchmark, and therefore it becomes more in that 10-20% range. But we're always going to answer the
at the high side, of course. I know. And in terms of quickly on timing, and can you trend following? It's a topic that always comes up periodically. Yeah. What are your thoughts on that?
That I think is a difficult one to the extent that you need to be able to know when to change your mind on those things and how quickly you can change your mind. So I think there are certain metrics that might lead us to be a bit more confident in trend. So, the average forward-looking volatility tends to be better if it's a bit higher. The average correlation between markets, trend tends to be better if it's a bit lower. But having said that, you need to be able to react. In order for that approach to work, and in order to be a bit more adaptive, number one, you need to have other things that you're going to allocate to fairly quickly. And number two, you need to be able to make that change fairly quickly. And given that practically for most people that's unrealistic, I would err on the side of saying don't bother timing it. And in particular, you have to be tolerant of periods of poor performance. It's not a high sharp strategy, and therefore you'll go through periods of poor performance, and those bits that it tends to do very, very well are often after it's followed some period of worse performance. So we and look, I think most clients these days and most investors they appreciate that, and they understand that, and they've been through the bad times as well as the good times, and that leads to a slightly more kind of long-term outlook.
Yeah, no, I just got a few kind of different types of questions that I wanted to touch on. One is something that hasn't really been an issue for quite a few years, and that's cash management, because there were no return. In fact, we were doing our best to minimize the drag, I guess, for investors. Prior to that period, of course, a lot of people just left all the money we were having from the funds in the bank. And then we realized, whoa, banks can go down. So that's not a good idea either. Now we don't live in a zero interest rate environment anymore. So I'm just curious, what do you do with the cash that sits in the various funds you manage, but that you don't need for margin purposes?
Yeah, so we have a cash management team. at Man Group, and it's a central team. It runs across all of the different divisions, and we don't try to do anything heroic with that cash. We'll try we don't want that to be a source of risk whatsoever. We just want to make sure that in a risk-free sense, we're getting the best yield that we can. So normally it's a combination of T-bills and various kind of very secure government debt, and that's I know that there are people who try and be a bit more kind of risk-taking on that part of the book, but I just think it's for us that's not where we should be, trying to take risk or make money.
Yeah, no, absolutely. Now, another thing I wanted to ask you, more like kind of a rapid fire question, maybe even, and that is, what's the one thing you hear about trend following that you disagree with the most?
Ooh, that's a good question. I disagree with the most.
Yes. Yeah, we didn't want to make it easy for you, of course.
Yeah. There's sometimes a sense with people, and the reality is, at least the noise or what you hear or topics of conversation can be quite short term. If trend is doing well, then there's not much complaining, and if it's doing badly, there's much more complaining. And I think one kind of problem that or complaint observation that we used to have is, but you take all of these big directional positions, and they're going to go wrong. You're going to be the wrong way around on the market, and isn't that going to blow up the portfolio type thing? And the reality is, actually, if you were to hold those positions, let's say we took the biggest set of exposures we happen to have at one particular point and held them throughout time, that would be a fairly disastrous thing to do. But the whole point, and so instead of thinking about point in time exposure, which is important, and you need to manage those risks, you need to think about how the system evolves and is dynamic. And so it's very, very different. If I go through a period of the performance, us being long equities and the performance being correlated with equities, I think it's that bit of saying, well, you just got equity beta. Well, we had it for those 3 months, but it doesn't mean anything about the next 6 months.
Yeah, no, I completely agree with that. Now, I've just got two questions left. The other one I was thinking about, and that is, if you're on the other side of the table, so an allocator looking in at one of your strategies, what would be, in your opinion, a question that they should be asking you, and also maybe something that during these due diligence conversations you kind of get the sense that it's never brought up, but actually it's quite an important question. Is there something that springs to mind?
Yeah, I as I said earlier, I think it's the investor's job to build conviction that this system or strategy or group of people running the strategy are going to do a good job going forward. And there are many parts of a system. There are many kind of components that make up that that build up that conviction. So I think it's a bit difficult to ask anyone. But what I would want as an investor is to make sure that you're running a systematic strategy. And so in theory, a systematic strategy is built on a set of rules, and it follows those set of rules. And I would want some reassurance that your process, as you evolve, as you perhaps modify the strategy or improve the strategy, you're confident in that process. The process is well built and it's well engineered, and it protects the integrity of the system as well as improving results going forward. I think that's the bit that I would focus most on.
Yeah, no, absolutely. Okay, well, we are recording at the very, very beginning of 2023. So I just wanted to finish off with a simple question, and that is, what are you most excited about, or maybe what concerns do you have for the year ahead? And you can choose whether it's about system trading, global macro events. It's all open field.
Open forum. Look, we started last year and we thought we're in a really changing world, and the environment's uncertain. And we start this year and it's even more so. You look back at the things that happened last year, and there were so many events. Take nickel. for example. That was way back in March. We were doing a review of the year just a couple of days ago. God, nickel, that kind of that huge event in the nickel market. So it was actually in 2022. We were all under work from home guidance in the UK in 2022. So such a huge amount of things happened last year that I, from a kind of macro perspective, I think we've all learned to run at this kind of really fast pace. The world the market seems to be moving so fast. So I'm kind of glad that we are in the systematic space and we have algorithms to try and kind of navigate it for us. And the focus for us as always, but particularly now, is making sure technology platform is fit for purpose. And as you think about kind of next generation and what asset classes you're trying to add, and you make sure your research platform is doing the best job it can for all of the researchers. And so it's that's our kind of big thing for this year, to try and focus on what you can do to improve things and try as much as you can to block out all the noise.
Yeah, no, I think that makes a lot of sense. On that note, we're going to wrap up this fascinating conversation. Russell, thank you so much for being on the podcast and for sharing your thoughts and insights with us. We hope that we can do this again sometime in the future. And to all of you listening today, I hope you were able to take something from today's conversation onto your own investment journey. And if you did, please share these episodes with your friends and colleagues and send us comments to let us know what topics you want us to bring up in the upcoming conversation with industry leaders in the world of finance and investing. From Alan and me, thanks so much for listening. We look forward to being back with you on the next episode of Top Traders Unplugged as we continue our deep dive into the CTA industry. And in the meantime, go and check out the show notes for this episode and all the other resources you could find on the website. And not least, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.